Good morning, this is Spencer Levy. I'm an Executive Managing Director at CBRE Capital Markets, and we are thrilled to have back for the second year in a row, Joel Braun, the CIO and Executive Vice President at Acadia, a very large publicly traded REIT based in New York, owning properties primarily in the northeastern United States. One of our biggest clients, and Joel, we're thrilled to have you. Thank you for coming back to us. So Joel, what we're going to talk about today is some of the things that are going on with Acadia and in the market as a whole. Let's start with this. One of the new trends, I'll call it new with quotes, is that a lot of people are moving into urban or high street locations because they feel that that is an area that is poised for tremendous growth when you see perhaps some weakness around the traditional community and neighborhood shopping centers. But you at Acadia have been in that space for almost 10 years and been very successful. Tell us why you went into it 10 years ago and how it's been going.
Sure. We went into the urban space about 2003, and we really did it based upon two reasons. One, because we looked at the demographic changes and felt that there was a truly fundamental change going on from the suburban to the urban markets. And the second is because we just saw too much square footage per capita in the suburban markets and felt that the urban markets were relatively underserved and the suburban markets were overserved, and because of that, we didn't see the ability to push the rents the way we could in an urban market.
And I've been to some of your locations in your urban markets. Not all of these we would classify as quote-unquote high streets, not all luxury. Is that correct? Some of it is more moderate retail, and even there is a segment you find attractive.
Right. I think it's all about the number of people and the demographic push. So it can be both a high-end and a low-end demographic, but it's still the population that really matters. We sort of the joke that when there's a retail store go bankrupt or go open in a small market, it's very tough to fill. But in a stronger market, in an urban market, there's always somebody that'll sell something to somebody in those markets.
And certainly your Fordham location would be that example. Just an unbelievable density over there.
Right.
So let's go to one of the segments where you are also a big investor, which is the grocery anchored segment. And if you heard our prior interview with Craig McNabb, we certainly debated the encroachment on that space, both by smaller grocers and the internet. And I would suggest to you that other people have been seeing some reasons for concern. What's your opinion on the grocery anchored space, and how do you best position yourselves there?
Right. I think when listening to that interview, I think he was actually correct. I think that the grocery business is besieged from very many different directions. I mean, just walk into a CVS or a Walgreens and you'll see how much food they're selling relative to the way they were 5-10 years ago. And I think that the grocery business is a very tough business to make money in. You really have to be on top of it all the time. It's a hard business, and I think it'll come under increasing pressure as the time goes on. So only the strongest will end up surviving.
And then one of the things that we talked about, in addition to the encroachment from the pharmacies and the specialty grocers, was the internet. And one of the things that's happening is this change in tax laws, which may allow grocers, or rather distribution centers, to move into local locations. How much of an impact do you think the change in tax law may have, not just on the grocers, but on some of these other retailers?
You know, I think it's all about execution and service. I think it's always been about execution and service. And it's not easy to execute. So the idea that you just simply have the opportunity, because there's a tax law change, to go in and open up all kinds of distribution facilities, it's very difficult to perform on. I mean, the Amazons of the world can perform, but how many Amazons really are there? So that's a ways to go before you'll really see an impact, except for the Amazon example.
Right. And as I mentioned in the prior discussion, I believe that grocers only are impacted 1 or 2% by the internet today, and well, if that were to double to something more than that, clearly would be an issue. But you're correct; it is very expensive to do distribution centers and to effectively do that model, because candidly, Walmart is a quasi-distribution center business now, with their ability to put out goods from their existing locations and otherwise.
Right.
Acadia, great run. Last couple of years, I think you're up over 50%. The REIT industry as a whole has done well, but Acadia has outperformed very nicely. Tell us some of the reasons how Acadia has maintained its competitive position in the REIT industry.
You know, I think a couple of things. Number one, I think the push to the urban markets was an important factor for us, and I think we've been able to increase our earnings more substantially in some of the larger REITs, and with the ability to go into markets where there's more growth like that. I think that'll continue over the years. But it's a tough change. You know, it's not easy to continue keeping that push going. So we'll see how it goes along.
Okay. Well, not a lot of people know this, but Acadia has several different pockets of capital, both REIT capital, and you also have certain proprietary funds. Tell us a little bit about, and tell our viewers, what the different pockets of capital that Acadia has and how they have different investment profiles.
Sure. We've actually been in the fund business since the early 90s, and when we went public in 98, we decided that we would keep the fund business because the investors in those funds have been with us for a long time, and some of them continue on to this day, 20 years later. So we decided that we would keep both the REIT business, which is a core acquisition business, looks for really core quality, with always the intent of increasing the quality of the portfolio. We're constantly buying into the top quartile of our portfolio, and that primarily has been in the urban markets, although the ex-urban, if you will, too. So it can be 25 miles outside of New York City, for example, is still considered an urban feel to it. And then the fund business is an opportunistic business, and we'll do anything and everything. We've done mortgages, we've done participating debt, we've done joint ventures, we acquire directly, we acquire stabilized assets that we think we're getting good cash flow currently, and we acquire deals that are ground-up development or redevelopments, or you name it. So we'll do anything with that business. We really have no restrictions on it at all.
How big is that fund, or the funds?
The last is $540 million, and we just did that a few months ago.
Great,
so,
congratulations.
We have a nice long term. We can do deals now that are 7, 8, 9 years into the future and still within the life of that fund, and we can do pretty much anything we want with it in terms of the different markets. We can go anywhere in the country and any type of product. So.
Wonderful. Let's talk about leverage for a second. Now, Acadia as an enterprise is very conservatively leveraged. I think it's about 25% overall. A lot of people are being able to get the returns that they're looking for today by really pushing the envelope in the debt capital markets. Acadia isn't doing that, but notwithstanding that, have had exceptional performance. Tell us a little bit about how you're approaching the debt capital markets and how that plays into your both short-term investment decisions and longer-term enterprise decisions.
Yeah. You know, I think the REIT business in general is not rewarded for putting much leverage on. If the leverage is kept at a lower level, if you look historically, you'll see, Green Street did a very good report on it, analyzing the performance of REITs relative to the amount of debt. And historically, you keep the debt low, you keep under control, you will be in a better position when the swings occur, and they always do. You know, so I think we'll keep our debt as low as we possibly can. Also, our cost of equity now, because of where the stocks are, is relatively inexpensive. It's not a whole lot different between the cost of debt and the cost of equity for us when we consider debt being a 10-year term, if you will. So, you know, the 10-year term might be in the low to mid threes, and the cost of our equity is just above 4. Not a whole lot.
Is that your dividend yield or your?
Well, overall cost.
Overall cost. Okay. Now, in terms of the REIT industry as a whole, or rather the retail industry as a whole, given your diverse holdings, both your urban retail, the holdings through your fund, which are more opportunistic, your holdings through your the REIT, which are tend to be somewhat more conservative. Tell us about retail fundamentals as you see them today. How are they doing? Is it fair to generalize, or do you have to really break down the different segments to get there?
Yeah. No, I think you do have to break them down. I think real estate's always been a local business, and I think it always will be. Different markets perform differently. You know, one thing we try and do, which I suspect most people in the retail sector do, is we listen to the retailers. You know, if the retailers are doing the business, then in the end we can charge the rents. And you can almost boil it all down to that. Retailers do business, they can afford to pay the rent. They don't do business, they come back for rent reductions. You don't want to have that happen.
Okay. Now you mentioned, going back to some of the things that we started with, the different retail formats, and you talked about shifting to the urban format, but you still own quite a few community neighborhood shopping centers. You know, that's the format that we understand has some weakness because of difficulty leasing up the inline space. As a format, do you think that format will change materially over time, or do you think the format stays about what it is? And as a real estate investor, you know, how do you look at that format as an open air center as compared to perhaps the urban center long term?
Right. Right now we're about 40% urban and 60% suburban.
Yeah.
I think we'll change that probably to flip it the other way around, or somewhere in that range. You know, interesting. Your comment about small tenants. We have not seen that actually. Our occupancies are high as they've been, and our creditworthy. You know, the credit losses are low. So we find that our small tenants and our larger tenants in our suburban as well as our urban markets are not. They're paying the rent and they're doing all right. The difference, I think, fundamentally is that they can't push the rents, or we can't push the rents.
Right.
They're just not doing enough volume to support a larger rent. And in some ways, we look at many of the deals that were in the early 90s to mid 90s, and the rents are, just about where they were. So they went up for a while and they came back down again, and you look and you say, I did a deal in 1995 and my rent isn't a whole lot different in some of those markets. So I do think it's market by market. I do think the urban markets do better and have more opportunity for growth in the rental stream, and in terms of just the amount of development that can still occur. But overall, the markets are fairly stable, and people are doing all right. It's just there's not the opportunity for growth, I think, in the suburban as much as there is the urban.
Well, I think that's really the key phrase you just stated there. The reason why people are shifting away from some of these suburban community neighborhood centers to the urban centers is the ability to push rents. Because pushing rents in the real estate industry as a whole, even outside of retail, if you take a look at the office space, with the exception of certain core markets like New York, DC, San Francisco, it's been very hard to push rents there at all too. And I know you, so it's the ability to not only buy right, but to grow right. And I think the growth factor, that G factor, is very difficult in some of these suburban locations. So last question for you, Joel. Future of retail. You've been in this business a while and you own a whole host of different retail formats. What's the next 10 years look like? What do we look at? What do we think is going to happen as an investor? How do we best position ourselves going forward?
Yeah, it's a good question. I used to think the future was 10 years. Now I think it's 6 months. If you can figure out 6 months from now, you're doing pretty well. I think it's always been a capital-intensive business.
Yes.
And I think if you follow the capital markets, you probably have the best indication of where the values of real estate are going to go. But if I could predict the capital markets, I probably wouldn't be doing this. I'd probably be retired someplace. So I think it's what you had in your last interview, which is stay nimble and have the right people, and recognize that it's a changing world and it changes in ways that you'll never expect it to, and anything you'll ever know, you're going to be wrong. So just stay nimble and stay alert of what's going on and be able to predict that 1, 2, 3 years in advance. You're doing pretty well.
Good. Well, slow and steady used to be the name of our industry. Slow and steady winning the race.
Right.
That's not our industry anymore, is it?
Right, it's hard.
Great. Well, on behalf of CBRE, I want to thank Joel Braun for joining us for the second year in a row at RECon. And a great job, Joel.
Thanks.
And
Nice
we
to
look
see
forward
you.
to catching up again with you next year.
Great.
Thank you very much.